Hi everyone, my name is Wilson and welcome to Syfe Insights. Today, we'll be sharing more about investing in China and highlighting some ETF that might be useful in your investment journey. Many investors are turning their attention towards China as they are the second largest economy and stock market in the world. More importantly, they are in a different capital cycle, both in terms of economic activities and monetary policy action. While other countries are increasing interest rates, China, on the other hand, has been able to cut rates thus far to promote growth as inflation is still range-bound. China can be a confusing place to start investing due to the arrays of different share classes available for investors. They are mainly split into two categories: companies incorporated in China and outside of China. Within each category, investors can find different share classes such as China A shares, which is considered to be onshore investments, while China H shares, REIT chips, T-chips and American depository receipts are considered to be offshore. Different share classes also reflect the differences in sector exposure. For example, A shares provide greater exposure to sectors like information technology and industrial, whereas telecommunications and energy sectors, for example, are a larger part of offshore market listing via H shares. Local retail investors once dominated the Asian domestic stock market, but their footprint has gradually diminished. Retail investors' holding fell to 42% of all equity holdings in 2020 from 60% in 2010, and we can see more of such trends as they grow. With China pursuing innovation and getting more digitally enabled, such as with Stock Connect, this provided more opportunities for foreign investors. At present, majority of the wealth in China is concentrated in real estate, but with stricter property market regulations, a shift towards investing in the stock market will be possible. A key driver for this will be China middle class as they become more educated about financial products and they will be more inclined to invest digitally. China has transformed over the past few years, and as they work towards a more innovative economy, new economic sectors where the government wishes to channel capital have emerged, and these include consumer goods, technology, healthcare and high-end manufacturing. From an investor's perspective, they can be seen as emerging themes such as cloud, artificial intelligence, biotech, and life science that can be invested with specific ETF for potential growth. In 2022, China's economy has no shortage of headwind, but over the past 6 months, we have seen China's State Council implementing different measures across sectors to boost China's economy. With these measures in place, China's government is trying to stabilize the economy and prioritize growth while pursuing a zero-COVID policy. We have seen China struggle over the past 15 months, and with regulation easing to stimulate growth in China, this could be the catalyst for Chinese equities to move in a different direction. When comparing China with other markets, we also see that China is trading at a low valuation based on an adjusted PE ratio. Even though Chinese equities have rebounded in the past few months, this suggests an undervaluation that could be an attractive opportunity for investors. Investors looking to diversify their investments can find that over a 5-year period, the correlation coefficient for S&P 500 and MSCI World is lesser than 1. This indicates that having exposure in China market will provide effective diversification while investing in a global portfolio. Despite the volatility in China market, there is still reason to look at Chinese equities based on valuation and correlation coefficient for a globally diversified portfolio. On top of that, the efforts of Chinese government signal that the shift in policy stance towards easing helps investors have a better understanding of the risks they'll be facing when investing in China. Syfe espouses a core satellite strategy, and with Syfe Custom Portfolio, client can be exposed to investment in A shares, China technology, or China consumer discretionary through ETF as satellite allocation. Clients that prefer to invest in a managed portfolio can explore our Syfe thematic portfolio, China Growth, which invests in companies at the forefront of China's new economy sectors with a focus on China's rising consumer class and fast-moving internet and technology sectors. And this can be adopted as the satellite strategy of your investment. Investors should also take note of the associated risks while investing in specific sectors, so we hope this video has shed some light on how you can better prepare yourself and take action for your investments.